I have one slide, and it focuses on the difference between public and private loan pricing. There's been a lot of talk about private assets and valuation. In prior webcasts, I've talked about real estate and private equity. I'd just like to focus on private debt with this slide. Basically, the takeaway being, we don't believe there's a pricing anomaly between public and private loan assets. So on this slide, there are the upper tier and the lower tier. And I'd like just first to focus on the upper tier of this graph. These are prices for two indices. The dark blue line is the CDLI, the Cliffwater Direct Lending Index, okay? And the narrower gray line is the Morningstar LSTA leverage loan index. And so if private loans represented by the CDLI and publicly traded loans represented by the LSTA were priced identical, okay, except for their yield differential, these lines would be the same. So there are a couple observations. One is both these lines hover near 100, the par price of the loan, and they don't deviate much from that. They did during the financial crisis. I'll talk about that. But these are effective 3-year loans. Okay, they're senior secured. They're floating rate. Those three factors basically ensure that pricing is not going to deviate too much from 100. Second observation is there are some differences between public loan pricing and private loan pricing, as you can see, but by and large they're pretty small. They move in the same direction. The magnitude can vary, but they're, in terms of pricing between publics and privates, they're very close. Let me focus, ask your eyes to move down the page to the graph below, which basically plots the discount, premium or discount between the private and the public loans. Notice you use the right-hand scale to look at this bottom graphic, but basically this plots in shaded area the difference between the two lines at the top. First observation: on average, public loans trade at a 3% discount to private loans. So you might at first say, well, gee, they're, at least in terms of price, maybe not yield, they're a little bit cheaper on pricing. The index, just a technical point here, the LSTA index is based on bid prices, okay? So the maximum someone would buy. So it is not the average of the bid and ask, and obviously it's not the ask. The average bid-ask spread in that market is at least 1.5%. So a good chunk of that discount goes away if you consider the nature of the public pricing. Second, there are some other technical issues like original issue discount, but basically there's a reason, a technical reason why public loans trade at a discount. The second is that discount has a very low standard deviation, 3%. So basically, pricing differences are very low, and they mostly relate to the liquidity premium. And I don't go into it here, but basically the narrowing and widening of these pricing spreads is related to the liquidity discount or liquidity premium that resides in exchange traded loans. That premium goes up, or in other words, the pricing goes down and during periods of stress and vice versa.